Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in, it's Joe Caccera with Real Estate Radio Live, the podcast series, as we continue through the week. Thank you again for tuning in. Just as a reminder, if you need any help on financing a purchase, refinancing, if you need any consultation or advice on residential financing, I'm here to help you with that. You can contact me at 408-838-9060, or you could email me, joe@reradiolive.com. Our topic today, we're going to cover two things. First part of the podcast is going to be buying a property and keeping your current property. This happens a lot in the Bay Area. I'm sure it happens a lot all over the place, but we do specific financing here in the Bay Area, where people want to move up or buy a home, but they want to consider keeping their current home because of some of the benefits around that. That'll be the first part. The second part, kind of going to dovetail on the same topic. I'm going to talk a little bit about what it's like to then be a landlord or an investor, so to speak. So if you keep your home, buy another home, all of a sudden now you're an investor and you're a potential landlord, or you have to hire a real estate management company, property management company to manage your property. So that's a new it's something new if you haven't done that before. So I'm going to cover both areas. Thanks again for tuning in. And just a reminder, to download, you could get the information at reradiolive.com. And do me a favor, give us a review when you get a chance. You could do that on iTunes or reradiolive.com. All right, so let's talk a little bit about buying a property and keeping your current home or current property. This happens quite a bit. The first thing I'm going to suggest, and you probably won't surprise you if you've been listening to this show for a while, is that get plenty of advice, do your due diligence, sit down and run the numbers. Don't make an emotional decision. Make it based on numbers and investment strategies and overall approach to what you want your future to try to look like. And so the first thing you want to do, and I help people with this all the time, so I'm happy to help you, or if you're listening, if you need some help, go to the people that you trust. But you really want to sit down and figure out first, is it something you could do financially? In other words, is it smart to do this? So let me give you an example of some different options. So let's say you've owned a home for 10 years and you have good equity and you owe $500,000 and it's now worth $1 million, and you're thinking about moving up, maybe you need a bigger home or a different location, whatever case may be, and you're thinking, well, gee, might be a good time I do have 20% for this down payment for the new house with my investments and savings, and I could just rent this place out. So this is where you want to, again, I did a show yesterday on the using the advice of your financial planner and CPA. You want to go back and revisit that for this particular option, and that is sit down with your tax advisor, whoever helps you on your taxes, and also your financial planner, and find out what it's going to mean. What exactly will it look like if you rent your current home out and buy another one? So the obvious one is you have a loan on your current property. And let's just say, for sake of conversation, it's your payment's $2,000 a month, and maybe with property tax and insurance, let's say all in, it's $3,000 a month is the total cost of that property, with property tax, homeowners insurance, and upkeep. Maybe you have a yard service or something. So $3,000 a month is your cost for that property. So as you're potentially exiting that property and renting it out, one of the things you'll need to do is then assess what average rents are. And if it's in the Bay Area here, for instance, the rents are very high. And let's say for sake of your evaluation and due diligence, that you find out you could rent this particular property for, $3,400 to $3,500 a month. And so when you look at that, the easy math would tell you that now you have a $400 to $500 a month positive cash flow on that property. So that may be a good thing. It may not be a good thing. I mean, I automatically think it's a good thing because it's a $400 or $500 positive cash flow. But then there's other things to consider, and that's one. So let's say it's $500. The easy math is that's a $6,000 a year positive cash flow. You could take that $6,000, you could apply it towards additional principal on that rental property, or you could use it, put it in investment vehicles, retirement vehicles, or you could use it to buy down your, pay down your current mortgage on your new home. Some people might say, well, if I have a $500 a month positive cash for my rental and my new payment is, $3,500 a month, then I could apply it in my mind with that additional $500 of cash flow. I'm really only out of pocket $3,000 a month on my new mortgage payment. So there's a lot of different ways to look at this. Cash flow is one. The other one is equity position. For instance, if you have a lot of equity in the exiting property and the property you're going to be renting, I think it's more desirable to potentially rent it. If you have very little equity, it could cause some problems. You might think, why am I holding on to this if it's a really slim margin, if you have very, very low or a small bit of equity in there? You might want to sell it and move along, because the problem with small margins in equity, let's say the same property that's valued at $1 million and you owe $900,000 on it. I mean, I'm not, or $920,000. So now that becomes a problem, because when you go to rent it, you're not going to have a positive cash flow. You have a very slim margin with equity. And the reason I get concerned, and I would throw up the caution flag for renting a place like this, in this example, would be there's a very thin margin of error. So if there's $80,000 to $100,000 of equity in your home, and all of a sudden the market switches or changes, and we have a downtrend for the next 3 or 4 years, and let's say you lose 10-15% temporarily over the next 3 or 4 years on this home, and you're forced to sell, you could be in a situation where you're going to take a loss or lose money. So be very careful in your thought process when you exit your property and buy another one and then keep your property to rent. These are some of the things I'm telling you that people go through, the exercise they go through. I do it on a regular basis, and so those are the things to think about. Another item is, if you are living in this house and now you are going to be renting it, it becomes a rental property, and if you hang on to it for, I think it's 1 year, I'm not sure if it's 1 year or 2 years as a rental property, then it becomes officially a rental property, and then you lose any kind of those tax benefits that you would have took from, that home and sold it. Most people probably know by now, I think, that you get a $250,000 exemption from your primary residence, tax exemption on properties for individuals, and $500,000 for a couple when you sell your property to take that equity, or if you go to sell it and you have more than $500,000 in equity, you get the first $500,000 as a couple tax-free. That's not taxable. Anything made up over and above. So if you walk away with, $1 million in equity, the first $500,000 as a couple is exempt from taxes, but the next $500,000 would be taxed. And so these are the things that you really want to keep an eye on and be careful about, and talk to your CPA about, talk to your financial planner. How does something like this affect your future in retirement? Depending on your age, is this going to be a liability that's going to come back and prohibit you from saving towards your 401k? Are you going to be putting additional money into a rental property? You have to you're responsible for that rental property. When someone's renting for you and the roof goes bad or the windows need to be changed or needs to be painted, that's still cost out of your pocket. So these are all things you should factor in. You should have a maintenance budget on your property as well before you think about renting it. What is the upkeep and the maintenance going to be on that? What are some of the things that potentially you're going to come across that you're going to have to pay some additional money to keep that up? And so if you end up renting a property because it sounds like a neat idea and it's exciting and people say, buy property, hold property, in theory that's good only if it makes sense for you as an individual. But if you hold a property and it ends up being a money pit and you end up, putting money into it on a regular basis that could have gone towards other investment vehicles or maybe your retirement or 401k or all kinds of different things, it could be a negative. So these are really some of the things to keep an eye on, be careful of when you think about buying a property and keeping their current property. The last thing I'll say before we take a quick break and change topics is that make sure you know the qualifying part. I'll go into that in the next segment. But when you exit your home, if you don't have at least 30% equity in it, a lot of lenders will not give you credit on your rents. So we'll talk about that more because that comes into play as you exit that home. All right, then we're going to take a quick break. We're going to come back and talk a little bit about becoming more specifically an investor or landlord and what that means.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
Hi, this is Joe Kuchera of Real Estate Radio Live. Thanks for tuning into our podcast. We are your go-to resource for all aspects of real estate, including buying, selling, refinancing, building, and legal and tax advice, and much more. You can subscribe to Real Estate Radio Live podcast on iTunes and Stitcher to listen to an engaging discussion about anything and everything real estate. So make sure you get our app, RE Radio Live, in the iTunes store to follow the show.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live, the podcast series. As we continue, the topics today are buying a property and keeping your current property. First part of the podcast, I went through kind of the variables there and the goods, the bads, and the things that you really need to think about in evaluating whether that makes sense for you or not. Now I'm going to talk a little bit about what it means to be a landlord, an investor, a real estate investor. Now, because once you decide that I'm going to keep this property and I'm going to buy another one, now you become a property owner of two, and now you are technically a real estate investor because one of your properties that you own is an investment property. One you live in, the other one is an investment property in this case. So what does that mean? A couple of things that are very obvious that you hear, but when I'm going to go through it because it's really worth, it's really worth covering all the variables when it comes to being a potential landlord. So when you rent a property, you have to make a decision depending how close you are to that property. Do you want to manage it yourself, or do you want to hire a property manager to manage the property? Now, the rates they vary a little bit, but if you hire a property manager, I think it's usually somewhere between they collect usually somewhere between 4 and 8 to upwards of 10% of the rent a month. And so those would vary and change. You have to check different property managers. These are some of the things to think about. So, for instance, if you have a $500 a month positive cash flow, but yet $200 of that, $200 of that is going to the property manager, then you know now you really only have a $300 a month positive cash flow. So, excuse me, something to really think about when you're considering being a landlord and renting a property and becoming an investor. The other thing is I covered in the first part of the segment is just the upkeep. If you do something like this, I would suggest that you sit down and do what I would call a scheduled maintenance, and that would be upkeep on your property. You know, how often do you need to paint it? What are the what are the windows like? What's the roof like? What is a lot of the landscaping? Do you pay for landscaping? Do you pay for normal garden, yard service? Depending on the type of property, there could be some changes and some differences there. So there's definitely something to consider and think about when having a rental property. Now, the other part of it is when you become an investor, what are you going to do? What is the strategy? What is the thought for that property? Long-term, short-term, and long-term. We talked kind of short-term on positive cash flow. It may sound exciting because you do have positive cash flow in this example, but what does that mean for the future? What does it mean for 5 years from now, 10 years from now, 20 years from now? Have an idea of why you're keeping a property. If you're keeping it because your belief is, well, gee, if I get at least 4 to 5% appreciation annually, that could be a nice investment 10, 15 years from now. I could have several $100,000 of investments in that property because of the appreciation in certain areas that really do have strong appreciation, historical data for that. But always keep in mind, too, that equity in a home is only valuable until you decide or not decide what to do with it. And what I mean by that is it's great to look at an investment property and say, look at this, I have $500,000 in equity. But then you have to decide what you're going to do with that equity and if it's going to be tax beneficial to you or not. Most people, what they do is once they have rental properties, they typically will go into a strategy where they might keep that property for a period of time and then they either see an opportunity with another property to buy. So if they do, they will sell their rental property and then you do what's called a 1031 exchange, which means you take the equity from your current rental property and you use it to purchase the next rental property. And the reason why this is a benefit is that, again, you do not get taxed on that sale of the property. You do not get taxed on any equity as long as you roll that equity into the next property. Matter of fact, you could even 1031 exchanges are very flexible. If you want information on that, I am not a 1031 expert, but we work with companies that help people with 1031 exchanges. And what I do know is if you sell an investment property, you could buy multiple properties. Let's say you have $500,000 in equity. You could buy one property. You could buy 5 properties. You could buy 6 properties. You could even buy commercial properties with 1031 exchange funds. So they're very flexible. There's a lot of things you could do. And maybe that's part of your strategy if you hold on to this property is, how could I build some potential wealth in real estate? Well, my other opportunities are building. I am personally a big fan of this because I believe that if you diversify, it's a really smart thing to do and anybody could do if you can. It's not always easy. But what I mean by that is I like the idea of having a couple of different properties, investments in real estate. I like the idea of having investments in retirement in the stock market. I like the idea of having other opportunities so that you're more so diversified and you don't have everything in one location. Now, I know some people that don't trust the stock market at all, and they don't trust any other investment strategies, and they do nothing but buy real estate. That's all they do. Any amount of money they have, if they, instead of a 401k or instead of investing in the stock market or in their retirement, I know people that and they've done really well. They're just saying, I'm just going to buy another property instead of investing. And this way I have a hard asset. I know exactly what I have. I could see it. I could touch it. I know where it's at. I don't have to worry about all of a sudden an IBM stock crashing 40%. Now, there's always a chance that you could get a big market correction in real estate. There's no guarantee of anything. But if you buy in areas and if you time it and if you understand the fluctuations in those particular markets and areas, I think it's a great, great opportunity. I really do. And that's why I'm seeing more and more people invest outside of California, specifically outside of the Bay Area, because it's hard to achieve a cash flow position here and have it make sense. I mean, in order to achieve a cash flow, you'd have to put so much more money down, and then you'd be, it wouldn't make sense because you're putting so much money down, you're using that money to buy down a loan so that you have positive cash flow, but yet it's a double-edged sword because now it's requiring a lot of assets to put down on a property to achieve positive cash flow, and you're really not because you're using money to do it. So you really have to balance those out and think about what you want to do as a landlord, as an investor. I think it's a great strategy. I work with hundreds of people that do this. I work with teams of people that help others invest in Texas, in North Carolina, Detroit, Florida, all these different places. So if this is something that you're interested in, if you're listening to this thinking, gee, I might be interested in buying a property, and turnkey property in Florida or a place that I could get positive cash flow, let me know. Check in, let me know. You know where to reach me, but I have some very good contacts with people that do this for a living. And some of them live right here in the Bay Area. They'll coach you. They'll provide you. They'll even take a tour with you to these different states and show you the inventory they have. And, Texas is one of the ones that continues to grow, and there's a lot of opportunity. We help several people a year buy places in Texas. We have a client right now that's looking to buy 8 to 10 properties in Texas, all about $150,000 to $200,000 each on purchase marks. So their position is they could put 20 to 25% down, and for $200,000 they could buy maybe 8 properties or 10 properties, which sounds crazy because you could never do something like this in this area like the Bay Area. So their way of thinking is, if I could take this $200,000 and buy 8 properties and I could get $800, let's just say for sake of a conversation, I could get up to about $800 a month in positive cash flow, not a bad situation. Now, the thing to remember, when you purchase properties in other states and other locations, understand one thing. Don't get caught up in thinking that you're going to have this incredible equity appreciation growth that you have here in the Bay Area. We are an anomaly here. We live in a unique area where property values have continued to grow. Do not think that same thing is going to happen in other states. Matter of fact, if you buy a place in Texas this year for $200,000, there's a good chance that 10 years from now that could be worth $230,000 or $250,000. You're not going to get the type of growth typically in those places that you do in highly desirable places to live, not only here in the Bay Area with weather-wise and business and the business environment, but all the other things that come with it. All right, that about wraps things up for today's show. Again, if you have any information, if you want to contact me, go to reradiolive.com, or you could call 408-838-9060. Thanks again for tuning in. Take care. Until tomorrow.
You've been listening to Real Estate Radio Live. For more information on today's program, visit reradiolive.com. That's reradiolive.com. Subscribe to our podcast. Discover more at reradiolive.com.